It's Monday in Thailand, nearly 7:30 a.m. I've spent the weekend trying to understand what's going on in the banking crisis and financial markets. I've seen everything since 1987. I started trading on the London Stock Exchange in 1987. Well, actually, I started as a broker. And then in October of 1987, 6 months after I started my job, we had the crash and I actually lost my broking job there, which ended up being the best thing that ever happened to me because I got hired as a trainee market maker. I'm going to tell you about that in a minute because it's quite interesting how my perspective on trading was compared to what's going on with the banks. We'll talk about that in a second. Well, the latest development, of course, is that UBS has bought Credit Suisse Bank at around 55 cents per share, a huge discount to Friday's close, which was $186 per share. So shareholders have been wiped out. And despite how cheap that appears to be, UBS has still been offered a liquidity assistance loan of up to 100 billion Swiss francs backed by a federal default guarantee. So clearly Credit Suisse must have been in a serious amount of trouble to be forced to sell itself to UBS at a huge discount and for UBS to be given up to 100 billion Swiss franc loan. As economists announced, there could be up to 186 mid-sized banks who are in trouble in the US. Mid-sized US banks asked the FDIC to insure all deposits for 2 years. This is obviously not a short-term problem. A First Republic Bank is to face a second S&P downgrade in less than a week, even after the rescue package from the other banks depositing money into that bank last week. The banking crisis is so serious that the Federal Reserve increased its balance sheet by 300 billion in a matter of days. That's way more than the liquidity assistance they offered over the 2008 global financial crisis. So what did the Federal Reserve actually do? They offered to lend money at the face value of the bonds that the mid-sized banks held. So instead of offering to lend or buy the bonds back at market value, which I believe is something like 20% less than face value, they've offered to lend money at the price at which the banks paid. So they're going to make them whole, but it's a loan. So the banks have to pay them back. So it's a short-term measure. It just allows the banks to capitalize without actually having to take the losses now in the hope that eventually bond prices will recover and then they can get out of their positions without losses. So this is a short-term measure which may work. If inflation continues to come down, then the Federal Reserve will not have to raise interest rates significantly. So I guess it's a bit like if you bought a house at a high price, house prices are coming down now because interest rates are going up. You're struggling to afford to pay your mortgage. It's like the Federal Reserve saying to you, okay, don't worry, we're going to lend you more money at the price at which you paid for your house, so you'll be able to continue to pay off the loan. It allows you to pay off your mortgage during the period of high interest rates without having to sell your property in the hope that eventually interest rates come down and you can refinance your mortgage at an affordable rate. You don't have to take the loss on the house. But in the meantime, you do have to pay interest on the loan from the Federal Reserve. If you lose your job and you can't pay your mortgage and you can't pay the loan to the Federal Reserve, you're going to lose your house anyway. If you're a mid-sized bank and your depositors start withdrawing their money, then you will not have enough money to pay the Federal Reserve for the loan that they've given you on your bonds. So this isn't a foolproof system, but it's definitely going to work. Depositors have to remain confident in the banks. Bond yields cannot go significantly higher, otherwise there will be further losses for the banks, at least on their balance sheet, even if they don't crystallize the loss. And I would imagine the biggest risk of all is if inflation takes off again, back up to 8, 9, 10%, then bonds are going to collapse. The Federal Reserve is going to be forced to increase interest rates, and this whole situation is going to blow up again. What is the likelihood of inflation taking off again? Well, oil looks to me like it could have a good bounce and increase in price. I don't know about the other energy markets, but we do know that the US currently has an unemployment rate at a 50-year low. So right now, I don't think the consumer is particularly stressed. Even though the property prices have come down, they've got fixed mortgage rates, so they're not being squeezed particularly hard by higher interest rates at the moment. They may well do in the future, If interest rates stay high, then they have to refinance at higher rates. But right now, perhaps the consumer isn't really suffering. So if inflation does turn around and pick up, that's going to be a massive problem for the banking system. If you are a depositor in a mid-sized bank, you've seen what's going on. What are you going to be doing this week? Are you going to be thinking, okay, fine, I'm sure the Federal Reserve has made everything all right, so I'll just take a risk, I'll leave my money with the bank? Or will you be thinking, hang on a sec, I want to make sure I don't lose a penny, so I'm just going to do what the best thing for me is and move it to one of the biggest banks where they're too big to fail, and no matter what happens, I'll be bailed out by the Federal Reserve. Is that what you would be thinking? I certainly would. Maybe withdrawals will stabilize, or maybe they won't. What is going on at these banks? Who is managing the risk at these places? When I started trading on the floor after the 1987 crash, I was very lucky because as a trainee market maker, you go into the trading pits, you make prices on your own account, and you try and make money rather than as a broker. Before that, I was a broker where you get paid pence per lot to execute an order on behalf of a customer. And for me, it was far more exciting to be a market maker, trading on my own wits. The money was unlimited that I could make, as opposed to a broker where you're only going to get paid on how many orders you get. So it's an exciting time for me. I was very young, in my early 20s, and I had the opportunity to basically, if I worked hard, took some risk, but managed the risk properly, I could become very wealthy. I could become a millionaire with someone else financing me. I thought, well, I got nothing now anyway, so I'm just going to go for it. I'm going to take some risks. I'm going to really try and make a lot of money. I'm going to try and become a millionaire in my 20s. And I was very lucky because it was a time when you could make a lot of money quite quickly. And in fact, in 1992, I managed to make something like £1 million in a week when the ERM crisis hit the UK and the pound fell out of the exchange rate mechanism. And it's almost like the CEOs of these banks had the same idea. They could become wealthy with their stock options and bonuses if they took stupid risks, which paid off and made the bank money. But if it didn't pay off, they probably would have still walked away with their stock options. I believe the CEO of Silicon Valley Bank sold his stock for $3.6 million a few days before the bank went down. I doubt this guy's going to go to jail. I doubt he's going to have his money taken away. So if you have a system whereby CEOs of these banks can just gamble away the balance sheet, these problems are going to exist. They can get rich or they can lose their job. What would you do? And the decisions that they made, they bought bonds at record highs, at record low interest rates, when interest rates were being slashed because of the COVID pandemic, which was shutting down the global economy. They thought it would be a great idea to put all the money that they were receiving into the bank, into long-term bonds at record low interest rates. How does that make any sense whatsoever? So as soon as inflation took hold and as soon as interest rates started to rise, they were underwater with their investments very, very quickly. But the bank employees got paid tens of millions of dollars in bonuses hours before Silicon Valley went down. The bankers always win. The bosses always win. No one ever gets punished. They just walk away, probably get a job at another bank. I believe the CFO of Silicon Valley Bank was the CFO of Lehman's. The stories are just ridiculous, just laughable. I believe that commercial property prices have been collapsing, offices are lying empty, and surely the loans on these are going to hit the banks eventually. Surely this one has to be the next shoe to drop. And if interest rates stay high, property prices keep falling, eventually homeowners are going to be struggling to pay their mortgages. I believe that consumer credit is through the roof at record highs. People are using their credit cards to deal with food price inflation, energy inflation, that kind of thing. So I don't think this is the end of it. It could very well be the start of something very, very catastrophic for the banking industry. In fact, this very morning, the RBA assistant governor said the impact of rate increases has been delayed due to the increased share of fixed rate mortgages. So what he's saying is homeowners are not suffering with higher interest rates yet on their home loans because they've managed to fix rates when rates were very low. So does inflation take off because consumers not being reined in by high interest rates? Now the focus turns to the FOMC meeting on Wednesday. FOMC now in a really difficult position. They need to raise interest rates. Only 2 weeks ago, Chairman Powell said we need interest rates to rise and stay higher for longer to fight inflation, which is remaining stubbornly high. Even if the Fed only raises a quarter, and I think they have to raise, otherwise they're going to lose all credibility on the inflation fight. This is really a tough situation for the Federal Reserve, which they deserve because all this liquidity pumped into the markets, creating these huge bubbles. Okay, let's have a look at the usual markets and see some of the short-term support and resistance levels for trading on Monday. Gold pulled back to very minor support in the low 1970 area. Trendline at 65, 1964. Strong support around the mid 1940 area in gold if we fall that far. Silver has not been as strong as gold and is already pulling back to that 23.6% fib level. Big support level around 2200, 2190. Crude oil could really be about to see a decent recovery. A triple bottom here on the hourly chart with some strong bullish candles on each of the lows. Bullish engulfing candle on the first low, bullish engulfing candle on the second low. Could be a triple bottom. Oil could be about to take off these two downward sloping trend lines. We start breaking above $70. That's really going to be bullish for oil. Currency markets aren't so easy to read. If you're a subscriber, you've already got my trading levels on the sheets. The euro US dollar chart, you can see this broadening megaphone pattern, and in between here I really don't know what to do. So it really is a case of waiting for the market to hit the trend lines and then trying a short at the upper trend line, trying a long at the lower trend line. But in between here, anything could happen really. Aussie had held my sell level around 67.00, 67.20 so well throughout last week, offering some scalping opportunities. The Aussie dollar is now breaking higher. We're breaking up through the 500-hour moving average. We're breaking above the trend line in this rising triangle pattern. Dollar collapsed against the Japanese yen on Friday, but starting to recover. Now we'll see if the US dollar can head up towards 133, 133.30. That would be a strong resistance level. You might remember in my videos at the end of last week, I went into how the Canadian dollar versus Japanese yen, the Aussie dollar versus the Japanese yen, hitting very strong longer-term support levels and could recover. I could argue for a double or even a triple bottom pattern here. The candles with long lower wicks indicating that buyers are coming in at these levels. Recovery again today for the Canadian dollar versus the Japanese yen. Aussie also seeing some strength against the yen. I showed you a long-term support level in the Aussie versus the yen last week. Have a look at that video if you want to know why I'm calling that as a support level. A break above 89.50 for the Aussie versus the yen this week would accelerate moves to the upside. The US dollar versus the Canadian dollar is in this short-term triangle consolidation. As I talk to you right now, we are testing the lower trend line to this pattern at around 136.80. A break below there would be obviously negative. A break below the 500-hour moving average, which is around 136.5, would be further negative indication for the US dollar versus the Canadian dollar. Stock markets have been recovering as the central banks try to resolve the banking crisis. So we're seeing some strength in the S&P right now. We're trying to break above Friday's highs. That is encouraging for stock market investors. And if I scrunch up this 1 hour chart, you can see we really need to get through 4,000, 4,010 for the S&P to start making some more serious gains. NASDAQ is actually remarkably strong, having broken above the 12,430, 450 area, accelerating to the upside once we broke through that trend line and the 23.6% fib. Maybe we are heading up towards a retest of the February high, which is around 12,950. E-mini Dow Jones on the hourly chart. We've been in a bear trend through February and March, but maybe starting to recover. Could I argue that it is an inverse head and shoulders pattern? A left shoulder head, which is slightly lower than the left shoulder. Maybe that's a right shoulder. I could probably argue that, but you can see that if I draw a trend line on here, if we start breaking above this trend line, which is around 32,350, then we should see gains accelerate in the Dow Jones. And we could start heading up to 32,800, 32,900 quite quickly. Okay, that's my little outlook for the markets. We'll have another look tomorrow ahead of the FOMC meeting on Wednesday. Good luck.